On the emerging market question, so I think the answer is yes. The capital outflow, I think, will probably continue over the course of this year. That doesn't have to be, a crisis problem, but I think it's something that will remain a source of pressure. There's obviously going to be a lot of variation across countries, but current account deficits in some of the key large emerging market economies need to shrink further. And we think on balance that currencies need to be weaker and interest rates need to be higher in many of those markets before the adjustment is finished. In terms of the tightening of financial conditions, that has been a big issue for several of these countries over the course of the last 9 months, and coming into this year it's picked up. I think that does introduce downside risk to growth in some of those countries, and so if you look outside China at some of the other large emerging markets, you look at places like Russia, South Africa, Turkey, Brazil, I think it's quite likely that we'll see some further slowing in growth before things begin to stabilize, in part because those financial conditions have tightened more rapidly coming into the year.
At the margin, that's probably right. Yellen has spoken a lot about the forward path for the funds rate, optimal policy considerations. Again, Bernanke is of course has very similar views, but I do think that Yellen might be a little more willing to lean heavily on forward guidance to sort of achieve the recovery in the labor market in particular that she's seeking. But yes, I mean, this is the choice of continuity, and I wouldn't expect anything dramatically different from her.
So our outlook is for 7.6% growth, which I think is very close to the consensus forecast. If the external environment is improving as we think it is, and by external environment I mean faster developed market growth, a little bit more opportunity for exports in 2014. That improvement on the export side provides a little bit of room for policymakers to slow credit growth and credit sensitive parts of the domestic economy, particularly investment. So it's almost like a trade-off. If you get a little bit more growth here, you can squeeze down growth a little bit more there. So the improvement in the external environment is really critical to keeping overall growth near the desired target.